This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm your host, Karen Vergara, a senior journalist at Financial Standard. It is that time of the year again. And while tax season and the end of financial year might be the busiest time for accountants, spare a thought for financial advisors who not only feel the frenzy, but also have to be on top of the latest legislative reforms that impact their clients, many of which take effect on July 1. So to talk us through how he keeps calm during this hectic season, Troy Theobold, the founding partner and financial advisor at RFS Advice, is joining us today. Troy, thank you again for your time.
Thank you, Karen, for the invite.
Okay, Troy, just tell us a little bit about yourself and about RFS Advice.
Yeah, so RFS Advice, we've been on the Gold Coast here for over 25 years, helping people hopefully make good financial decisions with some confidence. We work across the board with a lot of, in relation to this, will be the pre-retirees trying to maximise those rules and contributions, then the retirees with cash recontribute type strategies that will benefit from some of these. We've then got our business clients and our higher net worth families with complexities that will probably have all of these issues that we're going to go over today. And then we do have our aged care part. So we're a broad-based business there. And in our spare time, I enjoy jumping on the radio and hosting a show, Retirement Living Your Way.
And Troy, there are so many changes as of July 1. Division 296 starts, payday super, concessional contribution caps in super will go from 30,000 to 32,500. The non-concessional contribution caps will go from 120K to 130K, and the TBC or transfer balance cap will go from 2 million to 2.1 million. So in just broad terms, Troy, tell us what the end of financial year looks like for you as an advisor.
Yeah, so generally you'll have clients that have either spoken to their accountant, been told I need to do some planning. They're surprised that 30 June's come around, even though it comes around every year at the same time on the same calendar. And it's really trying to make good decisions, not panic decisions. So if we can get in early, we can get calm early planning strategies and look at the long-term effects. So we're not forced into racing to ensure things are cleared, to ensure money's moved between accounts, which if unfortunately people, think the old days are still around, where right up to 30 June you can do stuff, those cut-offs are much earlier nowadays.
As per the reforms I just mentioned, which of these impact your clients the most and why?
I think it'll be a lot of people are talking about the 296 and that $3 million and the increased tax and everything. Reality is those clients in that and affected by the $10 million cap have probably already reached out. We've had meetings and spoken about that. So it tends to be people in the community that probably aren't affected by that are most concerned, but it's something that probably isn't going to affect a lot or most people out there in relation to their super. The payday super, look, that'll come and go. That's just having your systems and procedures in place for business clients there, just making sure payroll's got that in order. It'll really be around those contribution caps there and probably a lot of people wanting to change either salary sacrifice or contributions they've got going in, and then just changing those assumptions as well going forward into software, going how do we actually project that? What difference will that make over time? And then the hardest one is how do we get the information? So financial planners don't have access to the tax portal, which is very restrictive as an advisor. You need your client either to have their login to MyGov working to get up-to-date information. That's not always easy that people have, and they don't go in there very often. I know the accountants are saying a lot of their information now is going directly to the end client, not to them. So they're feeling a bit of frustration. So it's very hard to make decisions when you don't have information because there are real ramifications for exceeding those contributions.
And generally, which change is generating the most client questions or confusion?
The 2 to 2.1 is going to cause issues well into the future because some of those people might have started their pensions back when it was 1.6. Now they think, it's 2.1. I didn't get advice. I can go and add more in, which isn't the case. Even for us, it's not a simple answer. You need that login. You need to see what the transfer cap balance is shown on the portal via the ATO, and you need that information. So it's a very dangerous strategy for advisors playing around with those. If you've triggered it, how much is spare? did people take money out? Did they take extra pension payments, or did they draw it as a lump sum and give themselves some of that cap back? So that's going to be the biggest issue, and software doesn't solve that one, and I'm not sure AI is going to solve that one either, unfortunately.
It just felt like yesterday it was 1.6. Gosh, time flies, doesn't it?
Absolutely.
So how much of your time, Troy, is focused on explaining these changes to clients and implementing these strategies? So how does it impact your day-to-day work also?
Yeah, particularly this time of year, because if you're going to do a cash and recontribute strategy, which is really around minimising the hidden death tax we have in Australia, there's lots of talk around that. There's lots of information around that. It makes sense we're going to pull money out of super, put it back in, to do it this time of year in June and then again in July. We're going to create a new pension account for clients so that we're not selling down unnecessarily. We don't have too many accounts. We want to have simplicity. So it's juggling the tax world with the real world.
And do you think broadly that these types of reforms and changes increase the complexity of advice or compliance for advisors?
There's so many areas where things can get tripped up now. That if people are doing it themselves, it's very easy for them to get tripped up, and they'll come in and, can you fix it? It's not something you can fix once you've triggered these rules. You're then out, dealing directly with the ATO and going, I've done something and I need to fix it, and it's with accountants involved. It just becomes more complex to sort the problem later.
As a small business, what does payday super, what kind of impact would that have on your business?
I think, look, payday super, it's going to force businesses just to keep a closer eye on their cash flow and have more buffers there. And hopefully businesses are running with those. We call them hollow logs here. We like to have those sitting around. So there's plenty of cash flow money sitting in the bank to cover off on that. And I think it'll help people actually possibly, become more engaged in their super. They'll be able to log in, see their contributions. I think that's the biggest thing for a lot of the large super players out there. They just need to get their their client portal and their login easier and more engaging for more Australians to get more enthused about their super.
If we had a crystal ball and it's a year from now, the CGT discount rules will replace a flat 50% discount with an inflation-based calculation and introduce the minimum 30% tax. And negative gearing will be restricted to new residential builds only from that date. All right. What do these changes mean in terms of what you can be doing now to help clients? Is it like, as you mentioned, you're updating the modelling tools and assumptions and calculations to reflect the new settings?
Yeah, that's probably the main one that's causing issue or concern out there. Meetings with accountants. The consumers are wanting answers. The accountants are generally probably telling them we need legislation. We need to know what this is going to look like before we jump in and make rash decisions, because they're going to have long-term effects and outcomes. I mean, the way the budget looks at the moment, there's so many areas that are affected. We were doing a public seminar only a few weeks ago, and I was mentioning on that, if you look at the situation where you might have a husband and wife on a Part H pension, now they would be exempt under these rules from that 30%. However, if one is to pass in the couple and all of a sudden they lose the age pension, you're going to have people in their 80s needing to lodge tax returns. They're going to have tax to pay on capital gains. It really takes away their tax-free threshold for people in retirement. So I'm pretty aggrieved about that for them.
In terms of, I guess, just general questions clients are asking about the CGT reforms, what are these?
Yeah, I mean, the CGT reform, this new and particularly a lot of it's going to come around property. Do I buy a new? Do I buy an old? What can happen in regard to that? Now, the other fear is people go, I'm sure there'll be plenty of ads on the telly telling you to go and buy a brand new property in a unit blocks. My issue to clients is you only make money if you sell it at a profit. And if in 5 years' time yours is 5 years old and the building next door is brand new, the next person might prefer a 50% exemption on the new property rather than buying yours. So if they're going to be a gain, and what could that look like? And I think that's the issue. People haven't sat back to breathe and gone, I need to make a gain. Fundamentally, unless you're making a gain out of these, there's no point buying something just for tax reasons.
Kind of leads to my next question, and potentially what the unintended consequences are, do you see in broad terms that these reforms can have?
Yeah, I think we already had so many changes that when the budget came in with more change, the unintended consequences are huge like that. You're effectively taking away that tax-free threshold for retirees. If they were selling a bit of, a lot of people would have had some AMP shares or Telstra shares sitting around for ages that hadn't been an issue because they weren't going to read the tax-free threshold. Some of those in the future could, be having tax to pay. They probably haven't launched tax return for decades. So there's so many people affected. And in retirement, could have easily just had exempt people over age 65 or something or in retirement, just so that, retirees can't restructure. Business clients like myself, while it's a pain and our restructure cost will be significant based on these changes, we're at a stage of growth, it's part of business, but in retirement, it's an unfair change.
Yeah, absolutely. So finally, Troy, for other advisors, what type of advice can you give them in terms of how they can best be prepared heading into the new financial year and to keep on top of these, so many changes?
Yeah, I think the best thing is not be in such a hurry to rush out and be the guru giving the advice. So actually maybe a more structured and measured approach, getting more facts and information and not being rushed, because lots of clients are coming in they just feel like they have to do something, and sometimes being calm and doing nothing is the best outcome.
Yep.
So it's helping them through that process. Plenty of spreadsheets to work out the answers and then juggling the real world with the tax world.
Awesome, Troy. Thank you so much for your time. We really appreciate it.
Not a problem at all. Thank you.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.